Hello and welcome to another episode of Todd Miller TV. I'm downtown today at the law offices of Ryan Alexander. Ryan is very prominent and a well-known, knowledgeable attorney here in Las Vegas. Ryan.
Thank you, Todd.
Thank you. So here's a scenario. I've seen this. I'm sure some people out there might be in this scenario. Maybe back in the heyday they got in with some people and bought a whole bunch of rental properties, investment properties. They financed them all to the hilt, and they're all upside down. So maybe they've got 5, 10, or however many properties. Their personal finances are all good, but man, they've got all these rental properties stuck to their, with loans on them. What are their options, and really how can they resolve this?
Okay, well, there's a few different ways we can look at it. The first choice to make is, do you want to keep the properties? If you've put all this into it, how badly do you want to keep them? Because it gets more difficult if you want to. If you want to get rid of them all, it's easier. If you want to keep them, it's a little more difficult step. So we'll start with if you want to get rid of them all.
Okay.
The first things you're going to look at are short selling the property.
Okay.
And then we'll go to you and discuss a short sale.
Okay. So that they obviously, if they wanted a short sale, they could come to us.
Yeah.
So let's say so that's one option. They could come to us for a real estate agent. We could short sell the properties for them, get them out of them with maybe some recourse, maybe not, who knows. Right?
Well, and the legal side of a short sale is that the short sale contract that they're going to sign with the bank includes language that should get them out of the deficiencies or any obligations for the mortgages so that they're not liable for what's left over. And one of the things to look for in your short sale contracts, as you know, which is for the viewers, is to make sure that the short sale accommodates any second mortgages that you have, because you have to take care of the second. And most contracts are pretty fair, that they will give the second something to satisfy them. And it's usually $5,000 to $7,500,
Yeah.
and it pays them off. And you have to get both parties to agree, both banks,
right,
on the first and the second. And so I often tell people who are considering that, even though I don't execute the sale, I tell them, it's a lot easier if, for example, Bank of America holds the first and the second, than if an independent party like IndyMac or Aurora holds the other second, and you've got Chase or Bank of America on the first. So, but the short sale contract is supposed to get you out without any obligation left over afterwards.
Okay, so I'm guessing another thing they could do is just throw their hands up and say forget it, and just let them all stop making the payments, let them all foreclose. So they
Correct.
could do that. What if could they do it? Would bankruptcy be another option, and what would that look like if they wanted to? Could they do a bankruptcy of some kind to strip all those off? And would that be?
They can, yeah. So the bankruptcy to reorganize, for most investors, if you have multiple properties, it's probably going to be a Chapter 11. You could do a Chapter 13.
What's the difference between 11 and 13?
They're both reorganization bankruptcies, but it's more of a difference in scale.
Okay.
A 13 is for a person who has less than $1 million in investment properties, so that actually their obligations are less than $1 million. But also, it's a little tighter restrictions on how soon and how much debt needs to be paid back in a Chapter 13. Mm-hmm. So, for a smaller investor who has mainly condominiums or small homes that are under $100,000, it may make sense to do a Chapter 13, even if they have multiple properties, if they have smaller properties. But what we're finding lately is that a lot of investors, if you have 2 or 3 regular-sized homes in Clark County, that's over $1 million in debt, and you're forced into the Chapter 11 category rather than a Chapter 13.
So is it based on, because here this is a good point. So say you bought 5 properties, you paid $300,000 for each one, and you got 100% financing through this lender. So you have $1.5 million in debt. Now the value of those houses are today worth $100,000 each, which is that, and I know some examples where that happened. So you really only have $500,000 worth of property, but you have $1.5 million in debt. Then would that Is that 11? Is that 13?
That would still be an 11, because what's going to disqualify you from the 13 is the amount of the debt, not the value of the properties. I wish it were the other way around, because we could do a 13 easier. But no, it's going to be calculated based on the total amount of the debt, which are the liens and the obligations. So you're looking at an 11. What that's going to do, the upside of the 11 is that if you own $1.5 million in properties and they are worth $500,000, we can get the court to approve basically new mortgage commitments for $500,000, going out for 30 years at a new set interest rate. And right now, at the end of 2010, they're pegging it at about 5 to 5.5%.
So so it's possible that if a person's got rental properties, they want to make it work, meaning they want to keep the tenant in, they want to collect rent, and they want that to be an investment, they can go through this process and have that. Is it the loan? Now, the loan's not principal reduced, it's just the terms, right? Or
well, the terms are going to be changed so that you're only paying the market value.
Okay,
the current market value. So essentially, there is a secured portion of the note and an unsecured portion.
Okay.
So whatever you owe that's above the market price, you're not going to pay them zero, but you're only going to pay them a small amount over 5 years.
Okay, so obviously somebody would have to come in and go through their specific examples, because it might be that even after doing that, they still negative cash flow and it still doesn't make sense.
Well, the biggest question, whether it makes sense to do a Chapter 11, is if your mortgage payments could be based on market price, would your rental income cover it? Because if your rental income right now, as a snapshot in time, wouldn't even cover what a market price payment would be, then you can't qualify for an 11.
I can tell you almost certainly that if you pay market value interest rates on a market value loan, it certainly will make sense, because home prices are a third and rents haven't gone down that much. So yeah, if you could, that house is probably getting $1,200 a month rent, and for $100,000, if that's what it's worth, if you really bought it for $100,000, I mean, all your payments combined would probably be $800-900. You'd have profit in there. There'd be $300 a month. If somebody wants to meet with you, have a consultation, and find out more about their specific situation, what do they do to get in touch with you?
They can call me at 868-3311, and I meet with everybody personally. I'll go over all the requirements of different chapters of bankruptcies and which one fits what they want to do. And I'll also tell them not only what do they want to do and which type of bankruptcy would fit, but looking at it rationally without being emotionally involved in their financial affairs, looking outside in, what makes sense for them. Because a lot of people it's their hard-earned money, and they are emotionally connected to the properties because it was what they spent their life savings. A lot of people put their life savings down to buy rental property, and we have to take a cold hard look at, okay, what makes the most sense now? And I guarantee everybody that I'll tell them exactly what they should do based on their financial situation.
Good. Well, thank you very much.
Thank you, Todd.
That's the episode for today. If you have any questions, you can find him online, ryanalexander.us, his website. Everything's on there. Thanks for tuning in, and I'll see you on the next episode.